What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, I have a big video for everyone today because I think this actually changes things a little bit. Stay with me on this one. I'm going to try to explain it in a very clear, concise, and simplified manner. If you watched the video I made yesterday, it talked a little bit more about GameStop versus AMC. However, they are paired together because they are under the same category. Unfortunately, it is named meme stocks, but they are under the same category. And yesterday, in the video I made, I said I was really surprised that we did not see any bullish momentum out of GameStop. There was no big money behind it. And especially that there was news that pushed it up 33% after hours, which is a good jump. There was nothing coming in. There was no big institutions coming in, big money coming to push that stock higher. All right. And it did surprise me for a little bit. And if you watch the video, you know I was planning on doing a little bit more research. And today's Saturday, so I have a little bit more time to be able to dive into things a little bit deeper because the market is closed. I've also talked about in previous videos that you're slowly starting to see institutions coming out of this play. Okay. They're selling off of AMC when it comes to the 13F filings. Now, the 13F filings can be very difficult because there's a 45-day delay on them. All right. And in one sense, it shows that institutions hold more, all right, more shares than they did previously, like you've seen on some other third-party data providers, which we all know we cannot fully trust them as well. But when you look at the actual 13Fs, it does show a lot of them have sold off, which is understandable because the big money piling into AMC in May was what really boosted the stock price to go over, from that $14 level up to all the way $70. So here I want to talk about what just happened, what is going to happen that really changes things. I'm going to break down both the positive and the negative behind it and give you my full scenario. So let's get right into it. First off, I want to talk about what was released in the Federal Reserve's December minutes. Now, if you're unfamiliar, the minutes are nothing but a written, detailed narrative of what was said in the December meeting. 9 out of 10 times, it's just reiteration and confirmation. Now, every time the minutes are released, especially lately, the past year or so, that the Federal Reserve plays such a big part in the market, which they have numerous times, but sometimes when policy is a little bit stagnant for a while, there's not a lot of hype on it. It doesn't really change the market as much. But the past year, all eyes have been on the Fed. All right, and every single time going into the minutes, volume slows down a little bit. Place some puts into the minutes. They're released. And it's a pop and it's a rip right out of the gate. It's literally rinse and repeat. But the other day we saw something different. All right. And I was able to skim over things while still trying to manage because I got out of my put positions, trying to manage some of my long positions and so forth. But let's break it down. Central bankers indicated in their December minutes that they expect not only to raise rates and taper asset purchases soon. We've talked about that for months, but also could be teeing up a balance sheet reduction. Okay, this changes everything, and I'm going to explain why in just a moment. Okay, investors have been preparing for the Fed to start hiking interest rates. They also know the central bank is cutting the amount of bonds it buys each month. On top of that, they figured eventually the tapering would lead to a reduction in the nearly $9 trillion in assets the Fed is holding. Now, that's a natural progression. Also, the Fed holding that amount of assets is just a complete liability. Now, I've talked about this plenty of times before. I'm going to reiterate it again. Investors always look at history as an indication of what's going to happen. That's the only thing you can do. And the same thing when you're looking at a stock. If you're looking to play a chart, the right is always wide open. You can only look to the left to give you an indication of what is going to happen. So right here, what they didn't expect were all three things to happen at the same time. Okay, now the reason why they did not expect this to happen at the same time is because of what happened back in 2008. So I want to show this chart for you. Okay, this red line talks about is the Fed's balance sheet. Okay, shows the amount of securities. Oh man, I lose it. Shows the amount of securities held, and as you can see, it just continues to go up. So 2008 happens. Mortgage-backed securities go under, market pulls, real estate, real estate, housing, pulls, everything, monster. Federal Reserve does the same thing to help float the economy, just like they did after March 2020. And as you can see here, they're increasing, increasing, increasing. Well, it gets to a point where eventually, what do? They slow their asset tapering, which they're in the middle of, and they eventually try to raise interest rates, combat inflation, okay, start to offset some things a little bit, natural progression. As you can see here, by the time that they stopped their purchasing, this was mid to late 2014, it was stagnant for 4 years. Stagnant. They let the economy, okay, recover a little bit, housing recover a little bit, everything recover a little bit. Then they slowly started to reduce their balance sheet. That didn't last long, as you can see here, which then came, COVID and so forth, the pandemic, and then it just ripped right out of the gate. Now they've overextended themselves a little bit. You can see here by looking at this chart, this is a natural, progression, and this was just a lot harder, a lot heavier. Okay, they put on 4 million in assets in about, what is that, about 6 years? Let's say 3 million in about 6 years. And as you can see here, they went from 4 million all the way, trillion, guys, all the way up to even higher, okay, in such a short period of time. So naturally, they need to be a little bit more aggressive. However, this is what is shocking investors, okay? So now I'm going to explain how this relates to AMC. So, two things I think are going to happen. One, I think that's why we're seeing the price being, coming down a little bit. Yes, there is continued shorting and manipulation, but you also see less big money buying into these plays. Think about all the stocks that were hot in early 2020, all these high growth stocks. Okay, I mean, even look at Palantir. It looks like it's going to go to $15 because they cannot invest in anything that is risky right now. Okay, so they're switching all of their money over. Now, naturally, the bond rate is going to increase. The bond yield is going to move higher. Therefore, it's more enticing for investors to move their money over to bonds. So you have investors slow down the purchasing of riskier stocks, which AMC, in their eyes, tends to be a little bit of a riskier stock because they're still going on price earning ratio and so forth. Okay, so that's where you see a part of the big money not flowing into the stock. So where I see the play has changed a little bit, because that's why we had that gamma squeeze back in June. It was big money. I'm sure retail and FOMO, but the amount that moved, especially with a float this high, that was big money flowing into it. Once the 13F filings came out, it was full proof that big money pushed this thing. We might not see that happen this time. That's why I'm saying this changes a little bit. However, now you have an inverse effect. Okay, you have the stock price is going to go down a little bit. You have also the shorts that are in a very risky position. Okay, they have to do a whole bunch of reallocating, and they're getting to a price that is more enticing to them. Okay, now think about this. Nobody wants to sell when you're down 80%. But when you're down 10%, when you're down 15%, when you're down 20%, it's a little bit easier to be able to unload those, which is buying to close their short positions. Okay, when the price is $15, technically they're negative less than they would be if the price was $70. However, that's where I can see things going over the next few months. However, here's the inverse effect that could play onto this. They're just going to short this thing right back down. Once it goes up once, like I've said this from the beginning, okay, this is not going to be a one-time thing, which is why you still see people investing in, GameStop, even though it went to, almost $600 pre-market, 500 and change, whatever it is because it's going to continue. They're going to let it ride up. They're going to close their positions, let it ride up. FOMO, retail, maybe even them. Okay, maybe some institutions, some day trading part of the institutions, not really, like the bigger positions. Let it ride back up, short it on the way back down, and rinse and repeat it again. But it does change things a little bit. So just be prepared. I wanted to just kind of get this out to you while it was fresh in my mind, and I will continue to update as things change. Like I said, inevitably, even though AMC is a completely different, play than anything else, the way it reacts, and the way it moves is going to still depend on what is happening inside the overall market. because inevitably that dictates how their positions are going to be held and what moves they need to make. So, guys, that's it for this video. I hope I explained it in a good, good fashion for you. Leave a comment down below. Let me know your thoughts, and I'll see you in the next one.